All right, happy Monday afternoon, everyone. Hope you had a restful break and are ready for some auditing. So has anybody ever played any video games in their life? Like, so at the beginning of a video game where they do a tutorial mode to show you how things are working, okay? What we've done so far up to this point of the course is tutorial mode. We're starting the video game proper now, okay? So today is going to be a learning experience, as we have got a lot of material to cover and it's all very important. I do want to preface this particular section with a statement that I make whenever we cover this section in all of my classes. Um, it is not enough simply to memorize the things that I'm about to tell you. Memorization is going to be important, but application is by far more important. When we start going through the assertions, I'm going to list them all out and talk about them. We're going to be talking about these throughout the semester, and it's just if you know what they are and have a vague idea of understanding what they do, that's good, but it's not sufficient. You're going to have to know exactly how they're used in every single context. And so that is going to be the challenge we have moving forward. It's going to be the challenge for both assertions and evidence and the application. I have some stuff. Oh, yeah, I forgot to open. There's one other item I wanted to open before we got started, but of course, I'm messing that up too. It's a problem with getting old, is you just feel like you're fumbling all the time. Fumbling all the time. All right, we'll get that. All right. I've got a lot of support details for you, and we're going to walk through all of them in preparation for this, but we are covering a ton today. So I don't expect you all guys to get it in one sitting. I don't expect you necessarily to get it in the next week, but we're going to have a lot of reinforcement over between now and the exam, which, believe it or not, the exam is a week and a half away. It's next Wednesday. So everybody's excited for that. Like, enthusiasm levels are high. Yes. All right, here we go. Evidence and documentation. So remember, we talked about management assertions. I also called them audit assertions. At this point in the semester, when you hear the word assertion, you should think one of these 8 items. I say 8, you're going to hear me bad mouth one of them, and you'll find out why here in just a second, but it's a reflection. So these are the items that were in that first lecture. Again, first 3, big 3, completeness, existence, occurrence, VAA, those are kind of our primary assertions. They're the ones that are most relevant in most situations. I'd say 75% of the scenarios we're going to talk about relate to these 3 assertions. They have rights and obligations, which is considered to be assertion for all categories or for all standards. Then we have something called presentation and disclosure. This is an assertion that's recognized by the Public Company Accounting Oversight Board as a management assertion. So they recognize 5, which are these 4 over here, and then this 5th one over here. The Auditing Standards Board, on the other hand, recognized 2, one called classification and one called cutoff. By the way, you don't need to worry too much about learning all these. We're going to go each of these individually here in just a second. So these standards, PCAOB standards recognize these 5 as assertions. The ASB standards recognize these 2 and these 4 over here as assertions. There's another one that I'm going to throw up here, and the only reason I even include it is because it pops up in the book. It was an assertion a long, long time ago when the book was first written. It has since stopped being a management assertion for a very long time, but the book still categorizes it because for some reason the editors and the authors just don't want to get rid of it. And I say, let go of the past, folks. Let go of the past. You have to adapt to change and embrace change. All right, so what do these all mean? All right, let's go ahead and start out by saying, as I'm going through these, I'm going to classify them usually in 2 ways. I'm going to classify them as they relate to the operations of the organization, which would relate to transactions and events. So you can think about the individual transactions and events that take place on a daily basis. And in most of the situations, I'm also going to classify them as account balances, which is the information that's presented in the financial statements. All right. If it has 2 different lines of classification, then you'll know that it relates to both of these. If it only has 1 line of classification, then it will relate to either transactions, events, and account balances. And we'll delineate those a little bit more clearly here in just a second. All right, everybody strapped in? Let's get going. Completeness. Completeness is our primary recording assertion, and it basically says all transactions and events have been recorded, or all ending balances for balance sheet accounts that should have been included in the financial statements have been included. The way to think about completeness is that completeness is effectively just saying, did something get recorded? Something took place. Did it get recorded in the information in the system? Okay. Did it get recorded in the financial statements? So that's when you hear me say, what is our recording assertion? Your automatic response should be that's completeness. Now, that's a little bit confusing because we're going to talk about 2 other assertions that relate to recording, but this one specifically is did something get recorded, full stop? Is it in the system? basically is all we're asking here. And for the other ones, there can be conditional, like did it get recorded to the proper value or did it record in the proper time period? Those are separate assertions. This one's just saying, is it in the system? All right. So when we talk about completeness, completeness is generally tested in a specific direction. We're trying to test completeness moving from what we call bottom to top. And you're going to hear me talk about directional testing a lot. Directional testing kind of is the crux of this idea of these assertions. So completeness is going to be so we call from bottom to top. And what that means is we assume that the source documents of every transaction in an organization represent everything that's recorded for the organization. Then we can actually verify information in a system by starting with those source documents, because that's the foundation. So we start with source documents and we move up to what was subsequently recorded in the system. So moving from bottom to top. Everybody with me so far? Completeness is considered bottom to top. All right. So if completeness is considered, we know something took place to get it recorded, the next assertion is the exact opposite, okay? The exact opposite. This is called existence occurrence, okay? And now existence occurrence says all recorded transactions and events actually occurred and pertain to the entity, or all ending balances for balance sheet accounts that have been included in the financial statements actually exist. So with completeness, I said we know something exists. Did it get recorded? Existence occurrence asks the opposite question. We know something was recorded. Can we find evidence of existence? Okay. So practically speaking, if I said completeness was a directional assertion moving from bottom to top, and this is the opposite of completeness, what direction do you think we'd move? Top to bottom, okay? We start with the information that's in the records or in the information system, and we move down to the source documents. We've talked about existence already. We've talked about existence in a couple of contexts already. Remember, we used the inventory example, and I say if inventory is on the financial statements, we should be able to find evidence of its existence. How would this work in practice? Well, we would look in the system, we'd see, all right, what inventory do they claim to have in their inventory management system? We'd say, all right, 1,000 boxes of Cracker Jacks. I don't know why I picked that particular item, but it just sounded good, all right? 1,000 boxes of Cracker Jacks. We can go from that system, the record of this inventory item, and we can go walk out to the warehouse and see, 1,000 boxes of Cracker Jacks are sitting here on the warehouse shelves. That's moving from the record, what they have in their system, to going down to seeing what is the source. That's the actual stuff in the warehouse itself. We can also look at the source documents, such as the receiving reports, the invoices, so on and so forth. Anything that justifies the recording for that. So again, bottom to top and top to bottom are the directions that we test these assertions. Now, that's going to get confusing. Trust me when I say it will become a little bit easier once we start talking about evidence, because we're going to talk about specific types of evidence, and it'll clear it up as long as you remember the associations for the evidence. All right, so that's two of our assertions. The third assertion is really pretty easy to understand, given context of what it says, all right? And that's valuation, allocation, accuracy. You can probably hear me refer to this as VAA. You're welcome to call it VAA as well. Oftentimes I'll shorten the abbreviations. So when I say existence occurrence, I'll say EO, which sounds like old McDonald had a farm. Never mind. All right. So yeah, and then this is going to be VAA, valuation, allocation, accuracy. All amounts relating to transactions and events have been recorded appropriately, and all ending balances and adjustments for balance sheet accounts that have been included in the financial statements have recorded their appropriate amounts. So remember I said completeness is did something get recorded? This is asking a similar question, but it's saying, did it get recorded at the proper amount or for the proper value? So this is another version of the recording assertion, but it's more specific. It's looking at the numbers and making sure that it got recorded at the appropriate amounts and appropriate values. And this one's a really important one as well. I will say, like I said, the first three are the most important. If you do nothing else in this class, when you leave this class and you come back, 20 years from now, and you're a billionaire donating millions of dollars to the Department of Business Economics, and you're going to have your name in the school, and we're going to name buildings after you, and you come and talk to me, and I'm old and crippled, and I say, what are the most three important management assertions? I want you to name those right off the top of your head: completeness, existence, occurrence, VAA. Okay, you can say VAA. I'm going to assume you know what it is. All right. Those are the three that are most important. And like I said, 75% of real world scenarios deal with those assertions. But we have some more that we need to talk about. So let's go ahead and get into it. We have rights and obligations, okay? Rights and obligations. For all balance sheet accounts and any balances recorded in the financial statements, the entity holds and controls the rights to assets on the financial statements, or all liabilities or obligations of the entity. which sounds redundant because that's actually the definition of liabilities, but we're trying to say anything that's recorded as a liability is an actual liability. All right. Now, you will notice here something interesting. Even though there's multiple lines here, they're more clarifying lines. I only talk about balances with respect to rights and obligations. Rights and obligations is an assertion that only relates to account balances, whereas the first three assertions we talked about relate to both transactions and events and account balances. So they relate to operations, day-to-day operations, and the financial statement reporting. This assertion right here is specific just to financial reporting, the information that goes in the financial statements. So that's clarification on that. All right. Moving on to classification. Classification, all transactions and events have been properly recorded. I realize I transposed presentation to classification, but whatever. And then all ending balances have been recorded in the proper accounts. So this is, I guess, kind of a limitation on recording, but this is asking, did it get recorded in the proper account? This one seems very, very subtle and seems very, very minor until you think about the nature of earnings management that occurs in a lot of organizations. So we're going to talk a little bit about what the purpose of auditing is. A lot of times auditing is trying to make sure that a company is upholding its debt covenants. Have you guys heard that term before, debt covenants? So debt covenants basically is whenever a company takes out debt issuances or loans, lines of credit, they have an obligation to maintain certain financial ratios or certain amounts that they're supposed to meet. One big one is considered to be liquidity. You guys remember liquidity ratios from our finance classes back from 221? So current ratio, current assets over current liabilities. So let's say a company is struggling to meet their current ratio obligation on a debt covenant. And they say, well, what I'm going to do is I'm just going to reclassify this long-term asset into a current asset. What would that do to their current ratio? Make it go up. Okay, so you've got a notes receivable and you classify it as accounts receivable, makes that current ratio increase. So it makes their financial position look better. That's misrepresenting the classification of that item. And this occurs quite frequently with investments and liabilities, is that they try to misrepresent classifications to adjust liability or to adjust liquidity ratios. So this is actually a really important one that we have to be very aware of because this does occur in practice. So again, dual assertions or dual category assertions, transactions, events, and ending balances relates to both operations and financial statements. Then we have presentation. Presentation is slightly different, but related to classification. Presentations, all transactions and events have been clearly presented and disclosed, and all account balances have been clearly presented and disclosed. Ultimately, this is just making sure that everything goes into the information system properly, and then from the financial statement perspective, it's been presented in the financial statement properly. Okay, this one's a little bit more subjective, a little bit more challenging, but this is particularly important when we talk about financial statement disclosure of information. There are certain requirements according to GAAP. If companies fail to meet those requirements, they have violated this particular assertion. So an example of this, we're going to talk a little bit about concept of going concern. Do you guys remember we talked a little bit about going concern already? In the company, if we have this company is going to go out of business, the company actually has a requirement to disclose this to stakeholders, and if they fail to do so, that is a violation of presentation in their financial statements. So this is something we would assess in that regard. All right, next we have cutoff. Okay, and cutoff very quite simply is all transactions and events have been recorded in the correct accounting period. So a variation of another recording assertion, but this is saying that everything gets recorded in the correct period. So you will notice that there's nothing about account balances here. This is just isolated to transactions and events. So what does this mean? Well, let's assume that we're a company and we're really short of our earnings. Okay, we're short of recognizing our necessary earnings amount. So instead of recognizing transactions that are going to take place in the next fiscal year as sales transactions, we move them forward for a few weeks and we recognize them in the current period. So that actually inflates our income, inflates our income. But the problem is that those are not valid transactions. We call that fraud in the auditing vernacular. So basically for artificial inflation of income. But in this particular context, we would be testing what we call cutoff, trying to make sure that transactions get recorded in the period they should be recognized. Because remember, from revenue recognitions, that has to be when it's earned or realized. So that generally means that you have to actually provide some sort of evidence of the evidence of recognition of the revenue. Now we'll get into that more when we get to revenue process, but for the right now, what you just need to know is if a transaction took place in one period but was reported in another period, that's a violation of cutoff. And that's what we have to be aware of as auditors. All right, and then this last one, I'm going to throw it up here. I don't think this is a real assertion, but again, the book calls it a real assertion. This is authorization. Okay, all transactions and events have been properly authorized. Now, I will say authorization is very important with respect to controls. It's one of those segregation of duties that we've talked about, but it's not really an assertion. Again, the only reason I included it in here is you may encounter it reading through the book, and they may say it's an assertion. Actually, in the text of one of their items, they actually say, I think it's down here at the footnote of this table, it says, you know what, international and domestic standards recognize that this is not a real assertion, but we're ignoring that because we're textbook publishers. That's not what they say, but that's effectively what they say. All right. So here's a list of all the assertions and the categories. Real quick note, something that will save you a lot of headache and a lot of trouble. If you're ever confused about which assertions occur in transactions and events and which assertions occur in account balances, keep this in mind. All assertions are present in transactions and events except for rights and obligations. Rights and obligations is the only one that's not present in transactions and events. And all assertions are present in account balances except for cutoff and authorization if we want to count authorization, which we don't, but we will for context for purposes of this course. All right. So that's an easy way to remember it. What's the distinction is when we talk about the types of assertions according to category, we're testing assertions as to whether they relate to individual transactions, individual operations, organizations on a day-to-day basis, or we're talking about whether it's talking about financial reporting, the information that goes into the financial statement and the reporting system. That is the distinction. Oftentimes you're going to have the same assertion that's present in both categories, but it means something different when we consider it from transactions and events versus recording as account balances. So something to keep in mind there. All right, everybody clear on that? Everybody got full confidence that they know exactly those assertions, and you can apply those assertions in every scenario now? If so, we're done for the day, okay? But I don't have that confidence yet. The good news is you don't have to be a master of this, not even for the first exam, because we're going to be talking about this throughout the semester. This is one of, if not the most important concepts that we're going to be talking about, one of the concepts, if not the most important concept that we're talking about in this particular course. One of the most important, I can't believe I'm messing this up. One of the most important concepts, if not the most important concept we'll talk about in this course, is the concept of management assertions. And as necessary, I will harp on it. All right, so let's just take a quick look at how we would apply assertions here and what this means for moving forward. So this is an example of an audit program. So an audit program is just basically defining what the test work is that we're going to do in a particular area. And this is an example for accounts receivable. So for accounts receivable, the audit team has identified 4 assertions that they think are particularly important here, okay? So you'll notice it says existence, rights and obligations, completeness, and VAA, all right? Although it calls it accuracy, valuation, and allocation. So there's a few things that are important to note here. First of all, you can have multiple assertions that are very relevant. Frequently, you hear me talk about which assertion is the most important in a particular area. So I do want to shortcut this because this will make things a lot easier for you. When we talk about assets or revenues, generally speaking, the most important assertion is going to be existence occurrence. And then when we talk about liabilities, equity, and expenses, generally the most important assertion is going to be completeness. Now, I'm not going to leave that alone. I'm just not just going to say, take my word for it. And you say, okay, yeah, Dr. Barnes, we agree with you. We believe you 100%. If you do, great. I appreciate that. But don't take my word for it. Let's talk about why that's the case, okay? So you'll notice existence is listed as first up here. And I'm saying this is the most important assertion with respect to accounts receivable. So if we're documenting or if we're testing our clients' accounts receivable, are we more concerned about them having accounts receivable that don't really exist or them failing to record accounts receivable that actually do exist? Which guys do you think? It's one or the other? Probably the first one, okay? It's very likely that they would record accounts receivable that don't exist, because why would they do that? They'd be recording sales that don't exist. That's would be the counterpoint to that. So have companies ever misrepresented their sales levels in the history of all humankind? Yes, a few times, once or twice, okay? That's a very well-known fraud that companies do, is they tend to overreport sales because that overreports income. So we as auditors know that that's the case, and we want to make sure that accounts receivable do exist. Because if they don't exist, that might indicate that fraud is occurring with sales, all right? Now, that doesn't mean that completeness is completely and totally irrelevant. We still want to make sure that they're following proper operations. But let's talk about why completeness is important for something like liabilities, okay? So now let's think about accounts payable, a liability, an accounts payable. that would have a similar list of items right here, but it probably would have completeness listed first and say this is the most important assertion. Why is that the case? Do you think that we have the same problem with accounts payable that we have accounts receivable? Do you think that they're going to over-report their payables? Do most companies get into the trend of over-reporting liabilities? It's like, hey, we got all these liabilities. These are great. These are great. Can you believe all the liabilities we have here? They're going to say, yeah, we have minimal liabilities. We have almost no liabilities. And auditors are going to say, we don't believe that. We think you probably have more liabilities than you actually do. In fact, we have a test specifically for that purpose. We've got a test that we're going to identify liabilities that we're going to talk about much later in the course. But there's actually a test to try to identify liabilities that the client is hiding from us. Okay. We're more concerned that they may be underreporting their liabilities, which makes sense because liabilities are generally associated with additional costs. If they underreport their costs, what do they overreport? Income. Okay. So the opposite is true. We're going to be more concerned about completeness. But then moving on to talk about this, you will notice that over here we've got example audit procedures, and we're going to talk about each of these individually. Remember when we talked about evidence, we said the purpose of evidence is to confirm the assertions that we have existed. So from an audit perspective, the way that we classify assertions is that's our characterization of risks associated with particular transactions and reporting. The way that we test these assertions is we gather evidence surrounding these assertions. And these are all examples of evidence that we can gather. So hold on to this. We're going to talk about these assertions here in just a second. Or sorry, this evidence in just a second. But at a very general level, we need to talk about audit evidence. Now, I do need to note here, this is the first time that, or second time, this happened multiple times here in the course, that we have talked about synonymous terms. So for audit evidence, you're going to hear me say audit evidence, audit testing, audit procedures. All of these terms can be used interchangeably. They mean exactly the same thing. So keep that in mind. If you hear me say audit procedures, it's like, I don't remember him talking about audit procedures. Run back to this and said, oh yeah, this is evidence. That's what he's talking about. Or this is audit testing. They all mean the same thing. So audit evidence is information used by the auditor in arriving at the conclusion on which the audit opinion is based. This is generally tested at the assertion level, not 100% of the time, but I'd say for most of the scenarios that we're going to talk about in this course, we're talking about testing the assertion specifically. All right, trying to make sure that items exist, that the transactions are complete, so on and so forth. Now, at a very general level, we have three concepts of audit evidence that are important to understanding the conduct of audits. So before we can even talk about what types of evidence we collect, we have to understand what is it about evidence that is important, that has the criteria that have to exist for evidence to be useful. And there's three of these: the nature of evidence, okay, the sufficiency and appropriateness of audit evidence, and the evaluation of audit evidence. So that's really clear, right, guys? You understand that 100%? Just list those? No? Okay. All right, we probably better talk a little bit more in detail there. Okay, talk a little bit more in detail about these. Fortunately, I have slides for that. Nature of audit evidence is actually pretty easy. Because there's basically two categories of audit evidence. Okay, two categories of audit evidence. First of these is accounting records, which is a big long definition here, but by now everybody should understand what accounting records look like because you've been in the process of looking and reviewing and creating these over the entire time that you've been here at Truman State. Okay, so if that's one category, then the second category is everything else. All right, other information. So it's like that old anecdote, or the anecdote about Mark Twain. Mark Twain used to say, there's only two times in your life that you should not gamble: when you don't have the money and when you do have the money. Okay, that's kind of the same thing here. There's only two types of evidence. There's accounting records and then everything that's not accounting records. All right. Now, the reason this is important, the reason that we talk about this is because we tend to believe as financial accountants that accounting records are the end all be all. And accounting records do make an important subset of the type of information that we collect as auditors, but they are not the only types of information. We can gather information, other information, both within the entity and outside the entity, that do not take the form of accounting records. I'm not going to say accounting records are not important. They are a very core piece of information for auditing, but I want to drill it home really, really clearly. They are not the only source of information in an audit. And so understanding these other forms of information is really important. So for the nature of evidence, you should note that we can look at accounting records, but we can look at a whole bunch of other things too. That's kind of the takeaway from this. All right, next is sufficiency and appropriateness. Sufficiency is the measure of quantity of audit evidence. By the way, I think you've heard me talk about this. I really hate blank space in slides, okay? And so the next slide is entirely taken up with space, but I didn't want to leave this one, so I just copied something off Google Images. It makes no sense, but it's important to note that the sufficiency has to do with the quantity of evidence. We have to gain enough evidence to make a judgment. Sufficient evidence. So if sufficiency is a measure of quantity, what do you naturally think that appropriateness would be a measure of? It's another word that begins with the letter Q. Yeah, quality, okay? It's the quality of audit evidence, okay? Evidence is considered appropriate when it's both relevant and reliable. And relevance basically means the audited evidence refers to the relationship to the assertion being tested. And the reliability refers to whether a particular type of evidence can be relied upon to signal the true state of an assertion. All right. So think about relevance. All right. I ask for evidence that I want to test existence of inventory, but I get evidence that signals the evidence that there signals the completeness of inventory. Does that mean that the evidence itself is not valuable? I mean, it could be valuable in another context, but it's not relevant to the assertion that I'm testing. So I need evidence that's relevant to the assertion that I'm trying to identify. Then the reliability basically says, can it actually signal the true state of the assertion? So easy way to reliable evidence is to determine whether or not what source the evidence comes from, like how reliable the source is. So as we're going to find out in a little bit, certain types of evidence have more reliability than others, and it usually has to come from where that source of evidence comes from. What does the evidence emanate from? If we can identify that it comes from an external source, or better yet, an auditor-generated source, we tend to think of that as higher reliability. Whereas if it comes from the client and solely from the client, it tends to be lower reliability. By the way, has anybody seen kind of these concepts before, albeit in different terms, relevance and reliability? Have seen that in financial accounting before? So remember, FASB says in Statements on Financial Accounting Concepts 08, when it talks about the nature of evidence or nature of accounting information that has to be both relevant and representationally faithful. So yeah, this is kind of a throwback to that, because representational faithfulness used to actually be called reliability, but they called it something different because financial accountants are like that. But same concept in place is that want to have relevance and reliability. Both of those are important for audit evidence as they are for accounting evidence. All right, evaluation of audit evidence. Evaluation of evidence requires the auditor understand the types of evidence that are available. So what types of evidence can we gather in a particular context for a particular assertion, a particular category of evidence, and the relative reliability or diagnosticity of the evidence. We talked about reliability. This term diagnosticity, it sounds like a technical term, but it is. Basically, all it means is how well the evidence supports a given premise versus all available alternatives. So if we look at a piece of evidence and the piece of evidence signals something different than what we believe, that means that it's got high diagnosticity, even though we don't necessarily believe that it's diagnostically correct according to what we assume. This is actually a signal about something that we do need to be very aware of. And the next bullet point, you'll notice it says, evaluate evidence. An auditor should be thorough in searching for evidence and unbiased in its evaluation. So after the first exam, we're going to talk about professional judgment, some of the tendencies that people tend to exhibit in professional judgment. Has anybody ever heard of confirmation bias? Yes, confirmation bias is a big problem in auditing, as we tend to want to find evidence that confirms what we already what we believe. What about availability bias? Have you heard that term before? Availability bias is basically saying that we're only going to look at immediately available information, that we really don't want to go through the effort of finding other information that's harder to find. So we want to be thorough and unbiased. Those kind of signal both of those types of tendencies. All right, then we want to try to avoid those at all costs. And we'll talk about the importance of that when we get to that after the first exam. All right, so just as a reminder, we have 4 phases in audit testing, or 3 phases, but 2 sub-phases within those. So three primary phases with 2 sub-phases. So we already talked about risk assessment in chapter 4. We're going to talk more about test and controls in this, and we're going to talk about substantive procedures at length in the next lecture. But it's important to note that for each of these phases, we have defined evidence that we can gather during each of those phases. So before we can actually move forward, we need to understand what can we do in each phase, and what does that represent? What does that mean? So let's go ahead and let's talk about the types of evidence that we can collect. All right. So I believe there's 10 items here that we're going to list out, and we need to go through each of these in detail. So what do we say with respect to the nature of evidence? What is one of our primary source of evidence? That's going to be our accounting records. Okay. So for accounting records, we can perform something called an inspection of records and documents. And that is just as it sounds. We look at documents, we look at accounting records, and we try to determine if they support evidence in that area. This is probably our most important type of evidence that we can gather, because it provides a relatively high level of reliability and it can test multiple assertions simultaneously. Okay. Plus, it can be used during every phase of the audit, which is really, really nice. Now, I do want to talk very specifically about two forms of inspection of records and documents. We've got vouching and tracing, okay? Vouching and tracing. So remember I talked about how when we test completeness and we test existence occurrence, that those are directional assertions. These are tests specifically to test those directions. And I would like to take credit for this, but unfortunately this is Becker, so I've got to give credit where credit's due. The easy way to think about those directions is like this. You're gonna love this artwork. This is incredible. Look at that artwork. Look at that artwork. I usually get a round of applause for this artwork. It's so incredible. Yeah. All right, that was less than I expected. Well, okay. It is Monday. So pointing down, you'll notice that we've got arrowed down. So this is basically vouching test existence, which remember I said existence test from bottom or top to bottom. We look at our records and we go down to the source documents. So vouching is a directional test for existence. Contrast that to tracing, which is a test for completeness. Remember I said completeness test from bottom to top. We start with the source documents and we move up to what's in the records to determine if it got recorded. If you remember that vouching is a test of existence occurrence and tracing is a test of completeness, this makes things much easier because you can just add symbols to V and T to make it easy. Which I know this is silly, I know this is ridiculous, but it makes things so much easier to remember. As long as you just remember vouching and tracing. I do want to make a note of this, by the way, because this will come up. The book, Becker, and the ACCT are really bad about the way they use the word trace. Whenever I talk about tracing moving forward, I'm going to be specifically referring to as it relates to completeness. If you're planning on taking the CPA exam, they love to use the word tracing in every single scenario. The book does it. We're going to see this when we get to cache testing. You're going to see me get really angry because they use the word tracing when it's not tracing testing at all. And Becker does it, and even the AICPA does it, okay? Specifically speaking, we talk about tracing as a form of evidence. We're talking about gathering evidence to test from source documents to the records, okay? But if you see the word tracing used in any vernacular other than mine, other than the ones that I use, you will need to examine, it will need to determine, is it being used correctly? There will be multiple instances in this course where tracing will not be used correctly, even in homework questions, okay? And I will call them out and we will talk about them and I will say, did you make sure that tracing was used correctly? And if the answer is no, I'm going to say shame on you because I'm going to throw this out back in it. It's very frustrating. You would love it if just everybody in the world would use tracing properly, but apparently not everybody in this world is auditors. Okay, so yeah, if I had my own, everybody in the world was auditors. That's my heaven right there. Actually, that would be hell right there. Let's be honest. Let's be honest. That would everybody be asking questions and have professional skepticism. Yeah, nobody would be trusting in it all. Yeah. All right. Oops. Going back to these slides. I'm not here. I'm here. There we go. All right. Inspection of tangible assets. Inspection of tangible assets is just as it sounds. We look at an asset, usually a very large asset like a building or a piece of equipment, and we say, hey, look, it's there, okay? That's all there is to it. It is very, very high reliability evidence because the auditor is performing that test. However, it only tests one assertion. Anybody want to guess which assertion it tests? Yeah, I said, hey, exist. Good catch. Yeah, hey, it exists. Yeah, it only tests existence occurrence. And it can only be used during one phase of the audit, which is substantive testing, okay? So there are some limitations to it. Then we have observation and inquiry, which I want to join together. Observation is just as it sounds. You go and observe the client personnel doing their job. Inquiry is you go and ask client personnel about what they do for their job, okay? Observation and inquiry are great, and they can be used at any phase of the audit. So there are three types of evidence we talked about now that can be used during any phase of the audit: inspection records and documents, observation, and inquiry. Problem with observation and inquiry, oh, and they can test multiple assertions as well. They test multiple assertions. Problem with observation and inquiry is they're very, very low reliability. Why is that? Why is that? Well, think about observation, okay? If people are observing you, would you might maybe change your behavior if you think they're scrutinizing your activity? Yeah. It's like if Dr. Barnes is in the room during the exam, you're going to behave differently than Dr. Barnes is Tahiti when you're taking the exam, okay? Which I would never go to Tahiti. That's just too expensive. Hawaii all the way. All right. So yeah, that would be a different scenario. About inquiry, okay? You're committing fraud and somebody says, hey, can you tell me about these transactions? I don't seem to understand them. I think there may be fraudulent activity. Is it possible that somebody might lie about what they know? It's heaven forbid, okay? These are very low reliability tests. They're very versatile, but they're very low reliability. So we usually have to corroborate them with other types of evidence. So we actually gain an understanding and then use other forms of evidence to confirm that understanding. Speaking of confirm, we have confirmation. Confirmation, right now, all you need to know about confirmation is it is a third-party request. It is used for transactions that deal with external parties. This can involve cash. This can involve accounts receivable, accounts payable. This can even involve investments. Anything where a third party is involved, we can send a confirmation to. All right, confirmation is really, really cool in that it can test multiple assertions. It can focus on specific assertions depending on the category. If we're testing accounts receivable, it can focus on existence, because remember I said existence is important for assets. If we're talking about pay or liabilities, it can test completeness. They can test multiple assertions simultaneously. There is one thing I want to note, though. There's my biggest pet peeve that you guys will know. Confirmations get used in one phase of testing and one phase of testing alone. Okay? By the way, who's ever been assigned confirmation for Wednesday, you might want to make a note of this, because if you say it wrong, I will yell at you. Okay? Confirmations can only be used during substantive testing. They cannot be used as a test of controls. Okay? By the way, there is 100% chance I will ask you a question that will test your knowledge of this on one of the exams, if not multiple exams. You will come up and I will say confirmation will never be used as a test of controls. I will repeat those words, by the way, and you'll say, oh, I forgot about that. Don't forget about that. Confirmation can never be used as a test of controls. The reason why is confirmation is effectively a test of account balances, and controls relate to transactions and events of an organization. Okay. So we don't ever use confirmation as a test of controls. Never, never, never. Is there an exception? Maybe, but not on this course, okay? For all intents and purposes, we're gonna say never. Then we have recalculation. Recalculation is just as it sounds. We as the auditors perform recalculations of the client's estimates. We're doing the work, therefore it's very high reliability, but it only tests one assertion. Anybody want to guess which one? It's math, so it's probably something about value. VAA, valuation allocation accuracy, yes. Also, it can only be used during one phase of the audit. That's going to be substantive testing, okay? Reperformance. Reperformance is kind of cool. It's a very high test, a high reliability test. This is where the auditor reperforms a transaction, usually goes through a sequence of controls to make sure they achieve the same result as a client. Very high reliability because the auditor is doing the work. It can actually test multiple assertions, which is great. And it is almost exclusively used as a test of controls. Almost. We can do reperformance in substantive testing, but 95% of the time it's going to be used as a test of controls. So that's important to remember. And then finally, analytical procedures. Analytical procedures, we're going to go into a lot more detail on Wednesday. Analytical procedures can be very simple in scope. They can test trend analysis or ratio analysis, the things that you learned back in 221 in your finance classes. Or they can develop expectations from models to actually determine whether an account balance is correct. We talked about depreciation. Remember, I said we could do a depreciation analytical procedure to develop an estimate. And I said everybody in this course can do that because they've done financial accounting before. That's an example of an analytical procedure that we could do. So we're going to go into more detail on that on Wednesday, but for right now, that it can take multiple forms. Analytical procedures can be used during risk assessment. They can also be used during substantive procedures. There's actually a subphase for analytical procedures. However, they only test two assertions. Most of the time, like 90% of the time, it's going to be VAA, but I want you to make a note of this because it will come up. In one out of 10 scenarios, they can test completeness, okay? Very rare that happens, but it tests VAA completeness. By the way, did you guys write all that down, all the phases of the audit and all the reliability, all the assertions? If you did, great. If you didn't, I got good news for you. There's a spreadsheet on Brightspace that's got all of this written down, okay? This might be very, very important for you to refer to because on Wednesday, we've got a discussion where I ask you about all the evidence identified the last lecture, and everybody's been assigned to a piece of evidence down here, and you're going to have to tell me one of three things. What's the procedure? So how do you define it? What assertions can it test? High, medium, low reliability, and why? And the three phases that incorporate the testing, okay? So all of this is listed out here, except for the three phases of audit, okay? So let's talk about those real quick. So if you remember, going back, risk assessment, this is actually chapter 4. This is slide 15 from chapter 4. Remember I said the preliminary risk assessment procedures can have 4 types of evidence. 3 of those we already know because 3 of those used in every phase of the audit: inspection records, documents, observation, inquiry. And then we talked very briefly about preliminary analytical procedures. This was a precursor for this particular lecture right here, saying this is where we're going to use those evidence. That's evidence. So We already have this written down, but let's go ahead and talk about the other phases of the audit, because it probably bears mentioning. Go away. Nope. Okay. All right. So in the previous slide, I had the three phases of audit testing. We just talked about risk assessment procedures, inspection of records and documents, observation, inquiry, and preliminary analytical procedures. So those are the four types of evidence you can gather there. Test of controls. Three of these you should know right off the top of your head. Why? Because I told you three of them can be used in every phase of the audit. What are they? Inspection of records and documents, observation, inquiry. Good, okay. The fourth of these I said was primarily used as a test of control. Does anybody remember which one I called that? It was one of the re's. Recalculation or reperformance? Reperformance, yes, reperformance is almost always used as a test of controls. Not always, but almost always. Also, I want you to make a note of a fifth type of evidence. It's not in the list. It's called walkthrough. For right now, all you need to know about walkthrough is just a fancy term for combining all of the other types of tests: inspection, records, documents, observation, inquiry, and reperformance. We'll actually talk more about walkthroughs when we get to test of controls, but it's a very high reliability test that involves all those procedures combined. All right, substantive procedures. All right, so this is very easy to memorize. Very easy to memorize. Substantive procedures, substantive analytical procedures involves one type of evidence. Can anybody guess what it is? Substantive analytical procedures involves one type of evidence, and has it in the name. Analytical procedures, okay? And then substantive test of details can use all types of evidence except naturally analytical procedures, because we just performed those in the previous subphase, okay? So we can actually use any type of evidence here in test of details. All right, just a refresher: inspection records documents, observation, inquiry, analytical procedures, inspection record documents, observation, inquiry, reperformance, walkthroughs, and the substantive procedures, analytical procedures here, everything else right here. So I put that into the lecture now, and you can remember it for Wednesday. If you forget for Wednesday, you can come look at the approximately 32 or 42-minute mark in the lecture, and you can come up with this information. So real quick, let's talk about reliability. So you'll notice that I've got a list of continuum of reliability: observation, inquiry down at the bottom, inspection of an asset, reperformance, and recalculation at the top. What is the continuum for determining what the reliability is? And the answer is it depends on the source of the evidence. Generally speaking, if we consider this to come from the client, then we think of this as low reliability. If it comes from an external source or from the auditor, it's higher reliability. I'm going to use another Becker term. I used vouching and tracing earlier. I hate this next one because it's so cheesy, but it's really, really powerful. It's very easy to remember. What are the vowels of the English alphabet? A, E, I, O, U. Sometimes Y, but we're going to ignore that, okay? So A, auditor-generated evidence is the highest reliability of evidence, auditor-generated evidence. E, external evidence is the second highest. This would come evidence from external parties that are not the client. I is internally generated evidence by the client. O is oral evidence, which includes observation and inquiry. And then I hesitate to say this because I never want to give Becker credit, but they say you, and they say you know it, okay? That's what they say, legitimately say that. If you study for Becker, they say you know it, okay? So just as a refresher: A, auditor generated; E, external; I, internal; O, oral, which is observation and inquiry. That's the continuum of audit evidence, and that's the way to think about the reliability spectrum. So what we're going to be doing from here is we're going to be talking about the nature of evidence and where we collect it and what the implications are. We already now know the phases of the audit. So just as a reminder, we talked about the preliminary phase, the preliminary risk assessment, which is going to include engagement completion and risk assessment. Once we've completed our risk assessment, we move on to test of controls. Test of controls, that's where we make the determination what is control risk in the client, and that actually determines what we assess risk and material misstatement as. Remember, risk and material misstatement is how we determine detection risk. And from detection risk, we determine how much work we have left to do. So the way you think about this is that we're moving down a linear path, and more evidence we gain down that linear path is actually going to dictate how much more evidence we need to complete the audit. Now, the book has an example of this. The way that the book characterizes this is they actually have the assurance bucket analogy. And so they think about when you're in a phase of the audit, you're pouring some sort of assurance fluid into a bucket. And depending on how much assurance you get into that bucket at different phases of the audit is going to determine how much more you have to collect in other phases. So if you gain a little bit during risk assessment and a little bit more during test of controls, then the remaining has to come from substantive procedures and the test of details that you have to perform. And of course, this is going to be relevant according to what area of the audit you're performing the procedures over and what assertions you're trying to test. The idea being is that you're trying to fill a imaginary bucket with some sort of assurance and trying to get to the top. Once you've reached the top, that's sufficient. You've actually accomplished your goal. Now, this is an okay analogy, okay? This is an okay analogy. It is not my favorite analogy. It's not my favorite analogy. My favorite analogy is one called the Chipotle burrito analogy, all right? How many people have eaten Chipotle before? Okay. So you go in and you order a burrito, and they're a little bit more expensive than back in my day, but then again, everything is, so I'm going to complain like I'm about an old man, okay? But I want my value, all right? So I'd say, I'd like a burrito. What is the very first thing they do when they give you that burrito? What do they put on it? Unless you stop you, they put on rice. Okay, they dump the rice. They take like a big armful of rice and say, ugh, right there. They dump on the burrito. Okay, and then after that, they start putting on protein. They put on salsa. They put on pico. They put on sour cream, guacamole. You know, all the good stuff. Okay, what is the whole goal of them putting on that rice? What are they trying to do? They fill it with the nonsense, then that means that the good stuff they catch put less on, which is bad news for us, okay? As consumers, we're just kind of like, you know what? I really want the good stuff in my burrito. But if they're for them, that's good. If they put more rice on initially, that means that they have to put less of the good ingredients on later on, okay? So does everybody kind of see the analogy here is that they are trying to accomplish the same goal. They're trying to fill that burrito, and the more that they get up front, the less they have to do at the end. Now, what happens if you go in, and I've done this before, and I get shot angry looks when I do this, okay? And say, I'd like a burrito, but I don't want any rice on it. First of all, they'll stare at you for like about a half a minute, just kind of like analyzing your worth as a human being, okay? But then what happens? They put more protein on there, they put more queso, they put more pico, they put more sour cream, more guac, they put more of the good stuff on there because they have to fill the burrito with something. So for us, that's great, okay? More of the good stuff is always the best, okay? For them, that's bad because they have to pay more, they have to do more for that. Think about this in the analogy. Let's assume that I don't gain much assurance during risk assessment, and the controls are awful, so I can't get much assurance there. What does that mean about the work that I'm going to have to do at the end of the audit? I'm going to have to do a lot more work, okay? That's where I'm going to have to be putting the guac on the burrito, or I would put on the chicken on the burrito. My valuable time and effort is going to be at a premium because I'm going to be putting a lot more work at the end of the audit. As an auditor, speaking from the Chipotle burrito analogy, I would love to put more rice on the burrito at the beginning because that's a lot lower cost for me if I get that taken care of. So think about it from that perspective. We are eventually trying to fill that burrito up, and the more that we can get up front, the better we are. So we're kind of like we're kind of the people who are trying to put rice on a burrito, which I never really realized that before. That kind of makes us sound like the villains in this story, okay? But we kind of are. We're the auditors, so that's okay. That's okay. Anyway, take that perspective and keep that in mind. Now, keep in mind for Wednesday when we come back to class, everybody has been assigned to one of the types of evidence. You do need to be able to talk to all three parts of the question, okay? I won't necessarily ask you all three parts of the question, but there's 22 people in the class and there's only 10 assertions, so it's either 2 or 3 people assign assertion. So your goal is to come in and take notes, or sorry, to come in and be able to speak on that. However, I do want to make a note of this. We are going to go through it quickly, and we are going to go through it comprehensively. So in addition to being able to speak about the evidence that you've been assigned, I strongly, strongly recommend that you come in and take diligent notes here, because this is going to be our basically our final debrief for the exam, talking about how everything ties together, how the evidence, the assertions, the phases of the audit, the reliability all work together. And so this is going to be one of the more valuable times that we have to talk about this in this course. All right, with that, we are done for today. I'll see you all on Wednesday.